Welcome to our very first Martel Turnkey webinar. So again, I appreciate you being there. So now chat is working. So this is great. And again, so we're going to use the chat basically to if you have any questions as we're going through the presentation, and then I'll stop at one point, and then I'll be able to answer some of these questions, and then we'll see where that gets us. All right, without further ado, let's get started. I'm Eric Martel. I was born in French Canada, so that's why I have a little bit of an accent. But really, my first real estate experience was when I bought an 8-unit apartment building in my second year of university. I was able to do this because I was introduced to a real estate investor who had a lot of experience and who really mentored me through the transaction. And it was a big transaction for me at the time, obviously, and so this is kind of speaking to the importance of mentorship and being able to help each other, and this is one of the reasons why we're doing this today. I graduated in actuarial mathematics, so if you're not familiar with that term, this is really the math of financial risk. And after graduating, I worked as a consulting actuary, and basically every day I converted defined benefit pension plan to defined contribution pension plan. And basically that every day I was shifting the retirement risk from employers to employees. And this is one of the big reasons right now why we are in this retirement crisis. After a few years, I had enough. So I started working in management consulting, eventually moved to California in 2000. And I searched for passive income in all kinds of places, in consulting, in technology startup. We even started the gourmet sauce company. We started low-carb grocery stores, and we can talk. We have a lot of other businesses that we started as well. And really, eventually, it came down to my two sons who are on the call today. Antoine is on the call, as you can see, and my two sons and I decided to start a real estate investment company. And it took a lot of effort, but we eventually identified the right markets, and we were able to define the right strategy and build the right team to really provide turnkey rental properties for investors looking for passive income. And now I'm doing this full time, and my goal is to help people achieve financial freedom, and that's why we're doing this today. At the beginning, it was all about helping friends and family achieve financial freedom, and then really through word of mouth, networking, and our business began to be more known and spread out. We also looked at other turnkey companies, and we thought that maybe we can do it different. Maybe we can do it a little bit better and make it better for turnkey investors. And so that's some of the three areas really where we're trying to differentiate ourselves are about these three differentiators right here. So we want to make sure that the properties is cash flowing from day one. So when we sell the property to you, the turnkey rental property has a tenant in place, so you have cash flow from day one. Other turnkey providers you may have to wait to find a tenant. It could take a week, 2 weeks, a couple of months, so you don't know. But with our turnkey rental properties, you have a tenant from day one, and you're cash flowing from day one. We also wanted to have making sure that you never overpay, or you don't have to put more money down because the price that you bought the property at doesn't meet the appraised value. So for us at Martel Turnkey, if the price of the property is higher than the appraised value, then we will adjust the price of the property accordingly so that you don't have to put more money down. And finally, it's about third-party property management. So a property management company that is independent from us, that we can refer you to, and we don't get any commissions or referral. And this is the same third-party management company that is managing our property. So we can help you out in the relationship with that property management company, but we don't have a stake in that company. So these are kind of like the three differentiator and three areas where we thought it would really improve the situation for our passive income investor. If you are familiar a little bit with us, you know that we are in 4 markets right now. We're in Memphis, Cleveland, St. Louis, and Birmingham. But today we're going to speak about Cleveland, Ohio. And then we just maybe later on we're going to talk about other properties in another webinar, or if you want to have answers about other markets, I mean, you can look at our website or contact us. But today we're going to talk about Cleveland. So lots of good attractions, great city. There's arts, there's culture, there's sports with 3 major sports teams like the Cavaliers, the Browns, the Indians. So great city, and then the population there really has an identity and is proud of their city. So that makes we think that makes a great situation. It makes a great city to live in. But when we're looking at these different cities and these different markets, what we are looking at is some numbers that will really clearly identify that this is a good market for us to invest in. So here are some of the metrics that we're looking at when we're comparing city and markets. So we're looking for a diverse workforce. So in Cleveland, for example, you can see that the education and health services about 19%. We have a significant sector in arts and entertainment, wholesale, transportation. So this makes a good mix of a diverse economy, and that we're not really heavily reliant on one single industry. And if that industry collapses or is in trouble, then all of a sudden it affects the whole city's economy. So that's one of the key items that we're looking at when we're looking at these markets. So diverse workforce or diverse economy. Some of the largest employers in Cleveland are Progressive Insurance, Sherwin-Williams, the paint company, also Cleveland Clinic. It's a great hospital in the US. And also Cleveland has an area called the Health Tech Corridor, where they really incentivize companies like biotech companies, medical companies, and clinics to basically open up in that health tech corridor to provide services and do research. So this attracts, as you can imagine, a lot of very, people that have significant income, that have a significant education, and it really improves the overall city's condition. The other thing that we're looking at is the GMP, or gross metro product, which is really the GDP of the city, and at 360,000 per capita per person. We're really looking at the gross change, the annual change in the GMP at 4.24%, which is a pretty good. That means that the economy is growing quite well. If you compare at the GDP right now in the US, that's growing at 2.5%, 3%. So I mean, we're just above that. So this seems to me that this is a good working economy and growing economy. Also with a job growth of 1.3%, again, that indicates that the jobs are growing. We're not looking for very, very fast growing cities. Where we're looking for something that has a good growth, that is sustainable, and that the city can adapt and plan around that growth. And then that way we're not overpaying for properties. We can buy at a decent price, and then we can achieve our cash flow returns that we're looking for. Also unemployment rate, so a little bit higher than the US average, but still not significantly higher. It's not like a 10% or anything like that. So it's still pretty much in line with what we would expect. So I know this is a lot of numbers, and this is only part of the numbers that we're looking at, and I'm not going to bore you with the other numbers. But basically, we're looking at a lot of demographics, a lot of information, comparing different cities to figure out what is going on. So it looks like somebody doesn't have audio. Okay, so you can hear audio. Okay, thank you. So as I was saying, so there is a lot of data that we're looking at in order to identify these markets. And if you want to have the full details of what we're looking at, I'm happy to share that with you, in person. The next thing that we're looking at, so now that we've identified our market, we're saying, okay, well, let's look at, now we need to break it down into the different neighborhoods. Cleveland, I would say especially, but Cleveland has a lot of different neighborhoods, and each neighborhood has different characteristics and different price point and all of that. I mean, so we need to find the right neighborhood for the type of property that we're looking for, and that will actually bring us the right rent, that will also bring us the right returns. So the ones in orange are some of the properties that we sold last year in Cleveland. You can see that we have a couple. You can see which areas we like in particular. Around Euclid, up in the top right-hand corner. I thought I would be able to show my mouse, but not. Top right-hand corner, you see Euclid. So there is a $7 million trail project in Euclid going on right now. So we're looking for these kinds of situation where, the city, the neighborhood is investing into that area. The blue dot in the top right-hand corner near Euclid is an actual Amazon fulfillment center. So they converted a shopping center, and it's a little bit ironic, but they converted a shopping center into a fulfillment center. So that's giving jobs into that neighborhood, in that area. In the bottom right-hand corner, we have Maple Heights. There's another dot in there, blue dot, and that's another Amazon fulfillment center. And also in the, whoopsie, sorry, in the middle of the screen, in the blue dot, is also around University Circle that you see there. So this is the Cleveland Clinic, and to the left of that is the Health Tech Corridor. So this is where these investments are happening from biotech and from other clinics and medical research groups. So these are kind of the areas that we're looking at, where we're investing, where we have sold, and we continue to invest. So what we can do right now, I think this would be a good time before we get going to see if they have, if we have any question. So let's see. Anybody has any question? You can type it in the chat group here if you have any questions. Otherwise, I'll just keep on moving. Okay, so a question from Cole here. So thank you for helping also with the audio. Yes, how are we choosing the neighborhood? So in each of the city, we have a team on the ground that we rely on. We also look at, we're also pretty data driven. So we look at neighborhoods as well, the data associated with each of the neighborhood. And we look, for example, at a low crime rate in these areas. We're looking for average median income in that area. We're looking at rent, so we're looking at a lot of demographics in there. We're also looking at home ownership, owner occupied the property. What is the percentage of owner occupied properties and all of that. We also obviously have, as I mentioned, like the team on the ground. So we have a realtor that is really has the pulse on the market and is able to really identify the areas that we need to stay away from, and the areas that are real great opportunities for us to be involved with. In Cleveland, there's a lot of these pockets in these neighborhoods. So it's so our realtor is really key in that market to identify these areas. Another question here is why are you so focused on Ohio and not the other three markets? Right now, there's just there are a lot of opportunities in Ohio, in Cleveland that we see. So that's why we're focusing on that. We also have more bandwidth in that area right now. So that's why we're doing that. We see more opportunities right now that are coming on the market that we can go and go after and buy and get. We're not seeing as much in St. Louis right now. In Birmingham, the market has been a little bit I would say active, or not necessarily hot, but it's been a little bit harder to find good deals in Birmingham. And then same thing at Memphis. We had a hard time finding some good deals as well. All right. But if things change, we still have people in these markets that can identify deals for us and let us know that, hey, this is something that you need to pay attention to. That's it. Another question here from Steven. As a passive investor, do you recommend diving into other states or focus only on one state? I think if you're going to dive into other states, I think one of the big criteria that we're staying in states that are landlord friendly. This is something that's very important to us. If you're going to go there, you're going to have a better chance of finding a good opportunity. Also, if you have a tenant that doesn't pay, it would be a little bit easier for you to get rid of that tenant and put a tenant that's paying in its place. As you can see, we've done a lot of research to identify these markets. So if you're going with in other markets, in other states, in other cities, so you're going to have to either do that research yourself, or you're going to have to rely on somebody else to do the research for you and make sure that you double check their work. But that's kind of and then also, if you want to make sure that you have enough properties in one area so that it makes sense that you can build a little bit of relationship with your property manager, and you have a little bit of a critical mass, I would say. So if you're going to have, you don't want to have like one property in Cleveland, one property in Memphis, one in St. Louis, one in Indianapolis, and etc. So you want to be a little bit more concentrated, I would think. That would be my opinion. Okay, why would any turnkey company give good deals to others instead of investing themselves? So that's a very good question. So right now, our company, one of the reasons why we're doing this is really to help people achieve financial freedom and all of that. And then for us, our business is really providing these turnkey rental properties. We make money, obviously, on selling these properties. We make a profit on these properties. And then right now, we are investing that money into more turnkey properties. We also investing in multifamilies as well. And as you work with us on the turnkey side, you may be introduced also to multifamily deals where we're going to bring some investors in as well. But that would be later. But that's kind of our game plan, and we're planning to bring investors along with us on that journey when we kind of like switch towards the multifamily. But yeah, does it make sense to diversify my portfolio by state or buy in the markets that you guys have, as a follow-up to my question? So yeah, so I think diversification is good, but you have to have diversification, but also like a little bit of a critical mass. So I think I would recommend maybe have 4 or 5 properties in one city, and then maybe diversify into another city. And and I think that way you would have a little bit of be able to have a little bit of a team in each of the area, and then work with that property manager and work with, if you have a contractor, let's say, to make sure that they are that you can kind of tweak the system. You can talk to them and say, hey, can we do this a little bit better? Can we do this for me? And all of that. If you have only one property, it's going to be very hard for you to ask anything for your property manager. You're going to be just, you know, just one property. But if you have a little bit more, I think it's a little bit easier for you to ask for some things, and then you know, and then you know, improve and make it easier for you to manage your portfolio. About areas around military bases, as far as I know, we don't have any properties right now around military bases. Would you provide consulting throughout the process when it comes to renovations, dealing with a property management company, etc.? So all our properties have been renovated. So we buy these properties, we rehab them, rent them out, and then we sell them to you, the investor. So most of the time, all the systems have been updated. They have either new systems, or they've been repaired, or they still have a very good life in front of them. So you shouldn't have to do renovations for a while on these items. But obviously, in the long run, you're going to have to change the roof. You're going to have to make some changes. The property management company is going to help you deal with that. So they're going to work with you to identify that, oh, you need to change the HVAC, or you need to change the roof, or something like that. And then they're going to be providing you with a quote from a contractor, and then they're going to manage everything for you. They're going to get the contractor on site, letting you know that you know, you need a deposit, letting you know the progress of the project, and then asking you to basically cut in the last check for that contractor, and then you'll be done. They can send you pictures of the finished product, or the finished installation and renovation, and then you're done. So the property management company, once we buy the property, is really your boots on the ground, your team, and they're going to manage everything for you. All right. Any other questions? But I want to say, so Cole as well. So if there is a need, you know, for all our investors, I mean, again, these property management company, these are the same property management company that we use for our own properties. And so if there is any kind of questions, or there's any kind of, if you need our help to work with them, or talk to them, or figure something out with the property management company, we can definitely work with you and consult you through that process. So that's not a problem. So we're not going away, because we want to, first of all, we want to make sure that we have a good relationship with all our investors. All right, I think this is good. So let's get started. So if you've gone to our website, I just want to make sure that you know, this is where all our properties are. So the properties that we've sold, most of the properties that we've sold, properties that we have for sale, they're all there. And when you look at our website, you're going to see these kind of little icons, and then it shows you at a high level what the property is about. So you can compare at a glance and say, oh, you know, this one is a duplex, and this one, the potential ROI is higher, and all of that. And then when you click on each of these properties, you can really get a better idea, a little bit more details about the property. So for example, that 111 901 Kensington Avenue, so this one is sold, but yeah, $85,000, 1,000 square foot, 3-bedroom, 1-bath, and then it gives you the details of that. So the current rent, $900 a month. So for those of you who are who like the 1% rule, so it meets that 1% rule. The cap rate is good. And then we're looking at the cash on cash return, 16%. And we're saying here that this assumes that a 20% down payment with a loan of 5% and 5% interest and 30 years amortization. So that 20% is of $85,000 is $17,000. We're also assuming some closing cost in there. So the $17,000 plus $3,000 closing costs, that's going to give you your initial investment of $20,000 that you see on the left-hand side. Right. So then when we calculate the cash on cash return, we're looking at that net cash flow per year. And then we're dividing that by your initial cash investment of $20,000 to come up with that. And the net cash flow per month, the detail is on the right-hand side. So it comes with the rental income, property taxes, the insurance, and the property management. The property management is 10% of the rental income. Property taxes, we actually go into the property tax record to really figure out what the tax rate is, and it should be pretty close to that once you buy the property. Property insurance, we already have an insurance on the property, so we can. It's pretty close to that number as well. So you shouldn't be. We're very confident about these numbers. They shouldn't be moving too much. NOI is the net operating income. So this is basically the rental income minus property taxes, insurance, property management. And then you end up with 647. And then the debt service is the mortgage that you have to pay at 5% 30-year term. And then you end up with a net cash flow of $281. Right? So this is basically the property. You put $20,000 down, and you get $281 a month, and that gives you your 16% cash on cash return. So basically, if you were to put that in $20,000 in the bank, that means you have to find a bank that will pay you 16% interest on your bank account. So, so that's kind of where we are. Another property, so again, very similar, $75,000, again, 20% down. So that means $15,000 plus $3,000 closing costs. That's why the initial investment is $18,000, you know, and then we look at the cash on cash return and the net cash flow, $245. So on the right-hand side, again, so we have $800 rental income, the property taxes, property insurance, property management, and then we end up with a net operating income of $577. We paid a mortgage, $332, and then we left with a $245 net cash flow. All right, so that gives you your 16% cash on cash return. All right, and then so just one more example, and then we can go for some questions. So this one is on 169th in Cleveland, $100,000. This one is a duplex, so this is very interesting. It's a little bit different. $28,000 initial investment. So the purchase price is $100,000. The current rent is $1,270, so well above that 1% rule. If we calculate the cash flow, so on the right-hand side, the rental income is $1,270. You have the property taxes, property insurance, property management, and then we have the lawn, water, and sewer. So when we sell the single-family rental, the lawn, we assume that the tenant will cut the lawn, and they're going to pay for water and sewer. When we buy a duplex or triplex or fourplex, the landlord has to pay for that, for the lawn service, the water, and the sewer. So that's why this cost is there in that in the net cash flow. So this is one. So this is a good example here to show the difference in the cost. And so when you take all that, net operating income, it's 69, the debt service 403, and then we end up with a net cash flow of 466, and then the cash on cash return 20%. So these duplex and triplex, when they get on our website, they go very quickly. So if you see them and you're interested in great returns, so these are very good properties to get. So I've added on this slide the two big orange button at the bottom of the slide. These buttons, you're going to see them on our website when you go to the detail of the property. One of them, the one at the bottom right-hand corner, is download financials. And when you click that button, we're going to email you automatically a link that will show you the detail of that property, a breakdown about the property taxes, the insurance, whether you have to pay for lawn, water, sewage, or any other cost that you might have to pay. So it's going to give you the details for that. It's also going to give you kind of like what it would be like if you were to buy it cash versus finance. So it gives you a little bit more detail. It's in an Excel spreadsheet that you would have access to. So this is great. You can click on that button. There's no problem. And you just get that link and you can look at that spreadsheet. The other button is make an offer. So when you click that button, you don't have to give your credit card or anything like that. No money is going to be taken away from your bank account. What will happen though is that we're going to send you a purchase and sales agreement. So we're going to ask you what price you want to buy the property at, and basically your information, and then we'll email you a purchase and sales agreement to get that process going. And then we're going to take you through the process with either Angelica or Etienne, or we'll basically usher you through the process into the close. But that's the beginning of the process there. All right. So I think we can answer some more questions. So if you have any questions, feel free to send that to in the chat, and then I'll try to answer them. All right, so so the initial upfront cost for a purchase is about $20,000 initial investment. So the one that you see on the screen right now is a little bit more. It's about $28,000, and that's because it's a duplex. But typically, we're saying like $20,000, you would be able to buy a turnkey rental properties that would give you 16% cash on cash return. We have any other questions? Maybe can anybody have gone through our website and have looked at at these properties before? Maybe you can answer on the chat group if you've looked on at our website, looked at properties. Actually, yes, you can actually go on site if you want to see these properties. Typically, it takes a little bit of coordination because the tenant is in there, so you have to make sure that you coordinate with the property manager to make sure that you know, they organize a visit, they give the proper notice to the tenant. But it is possible to do that. Okay, so how many have actually downloaded financials, have clicked that button, download financials? So actually, yeah, so the terms, the lease terms typically are either 12 months or 2 years. So we try to get them as much as possible in a 2-year lease, if possible, even at a slightly reduced rent. But yeah, so normally you kind of expect like a 12-month lease. Well, you would see a profit right away on your investment. These properties are cash flowing from day one. So as soon as you get, make your investment, you would be able to make a profit. So if you look at this, for example, on a $18,000 investment, you would have a profit in the first month of $245, right? So if you're talking about recouping your initial investment, I mean, that's a different question. I mean, you have to kind of divide your initial investment by 245 to figure that out. But in terms of profit, you would make a profit from the first month. So that's a good question, Stephen. So maybe I'll research that one and I'll answer that later. So Antoine, I think, are you able to answer Stephen Zai's question about the fee for recording the tenant?
Yeah, so every market is going to have, I mean, every neighborhood's going to have a little bit different of a fee. We don't put it into anything of our numbers. Normally, I think, Stephen, correct me if I'm wrong, but I think it's normally $100 to do that. For just recording and doing that thing that you were talking about. So I don't think it's that much money, only $100 for the whole year. Yeah, it's like $100 ish. So we don't put it into the numbers because I also don't know if those markets are going to change their, like if it's raised to 200 and then, then what happens? I have no idea. So, because they're kind of at will with what they can do with those fees. There's no set structure and every neighborhood is a little bit different. So they're not in our numbers because it is such a low number, only $100 per year. But, going forward, if you want to factor that into the Maple Heights properties, you sure can. And then Malik has a question, typical vacancy rates for duplexes. So I would say typical vacancy rates, normally for duplexes, you're going to have one tenant living in there no matter what. Typically for duplexes, we see a little bit more turnover, meaning a tenant will live there for 1 year and then typically they'll move out. Single family homes, most tenants live there for 2 years and beyond. If they sign that 1-year lease and continue to stay on. So I would say typical vacancy rates is anywhere from 5 to 10% for both single families and duplexes. That's what I would put into your numbers if you're underwriting deals or looking at our financials. I would put in anywhere from 5 to 10% is going to be a safe number.
Yeah, and iTulie has a question as well around the eviction for non-paying tenants. So yeah, the property management company will handle the eviction process, and they'll let you know. This is one of the reasons why we are investing in landlord-friendly states, so that that process, the eviction process for non-paying tenants, is simplified. It's harder for them to defend not paying their rent. So yeah, I know that in New York, I can imagine. I know that in California as well, like evicting a tenant here, it's very complicated. It takes a long time. You have to cost a lot of money, and there's all kinds of ways for them to stay in your home. So yeah.
Yeah. Yeah, and then he had another question too about the rent. So the tenants will pay rent to the property management company. Property management company will take out all the expenses for that month, which is normally going to be any maintenance charges and then their property management fee. And then the rest of those funds, normally on the 15th or 16th of the month, they'll send those to your bank account. You'll use that money to then pay out your mortgage payment, which should be coming out of your own personal bank account as well.
Mm-hmm. You want to continue on that? The next one, Antoine, is about that vacancy rates again.
Yeah. Well, yeah. So, I mean, for vacancy rates, yeah, apartment buildings, it's going to be a little bit lower. Normally closer to the 5% number, but still for apartment buildings, anything 5 to 10% is going to be a safe number, in my opinion. You know, some apartment buildings we put in 7% just because of the certain area that it may be in, right? So while there's other apartment buildings like the one we just funded, we closed in January, where I put a 4%. So it depends on the area, the number of units, and yeah, definitely for larger buildings, closer to 5%. For more single family homes or duplexes, closer to that 10% number.
But I think for all the units that we have sold, I think we were saying that what we found was around like 5% was the kind of like the vacancy that we had seen. Is that correct, Antoine?
Yeah, it is, but everybody likes to run their numbers a little bit differently. Yeah. So a good range is anywhere from 5 to 10% to put into that number. I think our spreadsheet defaults to the 5%, of course, just because just as a placeholder, but you guys feel free to edit. All those financials that we share with you guys on the website are all editable. So you can go and change the numbers around however you see fit or how you feel.
Yeah, and then if you have any questions after that, I mean, Angelica or myself, you can contact me as well, and then or Antoine, and then we can help you through the process, answer questions that you might have.
How do you get over the fact that for duplexes you're required to pay certain utilities, but in single families? Well,
I get 20% cash on cash return. I get over it pretty quickly.
Yeah, well, I mean, they're going to have the very similar return. Yeah, and the utilities are very, and also for duplex, but I mean, Stephen as well, like for our apartment buildings, it's the same thing, right? So we have to pay for the exterior lights, we have to pay for the trash, we have to pay for the lawn, right? So the bigger and bigger that your buildings get, the more other stuff that you have to pay for that can't be passed off to the tenants. For example, one of the pluses for single families compared to the duplexes is also that we don't have to fill the units with appliances. Whereas now, as soon as you're in a duplex, you've got to put appliances in that building, right? So that's another additional expense for duplexes. But the pros of duplexes is that you're never going to be 100% vacant. So, you know, there's pros and cons to each one. We've seen through our data over the last couple of years that a lot of our clients really like the duplexes just because they sit on our website for an hour and a half and then they sell. So we know that you guys, you know, and all of our clients who are on our website really like the duplexes because they have a little bit of scale and you could still go and get that really good financing. And yeah, the utilities are variable. You have to pay for other stuff, but really at the end of the day, you know, you're getting two units, 2 tenants. Hopefully you'll never be 100% vacant. And then you're going to get, you know, a very similar return on paper to what the multifamily would, the single family, sorry, would generate.
Okay, so so all these, I also want to say also on Stephen's question too, is that the property taxes, I mean, you can really rely on that, but the property taxes, if you look for that single family, it's 100. And then if you look at the duplex, it's almost the same, so 117. So, I mean, you're recouping some of the costs in there because for that one building. The next question is for Malik as well, in terms of the what we're assuming in terms of is the cash flow assuming anything around the vacancy? And no, the net cash flow is really all the operating net cash flow. If you want to put, you can put another 5% in what we call reserve for vacancy, and maybe another 5% for maintenance if you want. But we can't predict that. So that's so these would be additional thing that you would put in reserve if you want to cover some of the vacancy in the future.
Yeah, and so right on, Malik, if you go to our website, find a property that's available, and then click that download financials button, you'll get a Excel spreadsheet of all of our financials. And then in there, it'll really see a breakdown of this, so you can make it a little bit easier for you. And then you can change around in there the vacancy and the maintenance number. And then it should be on the third tab on that Excel spreadsheet, on the leverage tab. You'll be able to see the number that includes that vacancy and maintenance. But yeah, we always market and share the financials of our properties about a perfect month. So this net cash flow that you see here for 466 is on a perfect month, right? There's no maintenance items, the property's filled, right? So that's what we're striving for, is everybody's hoping to get a perfect month on their property, right? So that's what we're showing when we do market these things out. And not every single month is going to generate $466. And then Steven's, I assume duplexes have outperformed single family homes. At the end of the day, they both have performed right around the same. Again, you have more turnover with the duplexes. While they are smaller units, you do have to spend money for that turnover. Single family homes, if you can get a good tenant on a long lease that's not going to move out, for 8 or 10 years, you never have to spend that turnover. That thing is going to be, a cash cow for you. Whereas duplexes, having somebody live in a duplex for 8 or 10 years, it's unlikely. So at the end of the day, I think that both the single family homes and the duplexes are pretty on par in terms of if you look long term, looking at the returns.
All right, then Susie is asking, sorry, if we were going to invest in one of your turnkey properties in the next few months, which city is your favorite city today? Well, our favorite city is Cleveland today.
Yeah, Susie, you missed it. Yeah, we've pushed a lot of.
The whole was about Cleveland today, and this is on the single family. I mean, this is what our focus on this right now. There are a lot of opportunities in Cleveland in very good neighborhoods, and we have the bandwidth to deliver on those. So that's our key market right now.
Yeah, we've seen the best success over the last couple of years with the turnkey product we were selling in Cleveland. Therefore, we were like, they have the bandwidth. We might as well just double down on Cleveland. Bandwidth in terms of our contractors being able to do the amount of volume that we want, and then also the amount of inventory that was available. Birmingham, I haven't seen a good house listed that I could, sell or renovate in the last 4 months. So I'm not going to go out of my way to go and find properties. It means the market has gotten too hot. So we've been pushing everything over to Cleveland, Ohio, to just because things are working. Our investors have had great returns and great success there with their properties. So we thought we might as well just double down, and that's what we've been doing, really just pushing Cleveland as hard as we can.
Yeah. I'll let you answer. Can you answer also the one about choosing the tenant?
Yeah, sure. Would we have any say in choosing the tenant? No. The reason why is because most of these properties, when you buy them, they're going to have their renovation just completed, and they're going to be on the market for rent, right? So they're going to be on the market for rent. You're going to buy the property. You're on paper going to close in 30, 45 days, right? But what happens if we let you choose the tenant and it's not a tenant that we would have chosen, and then we, you back out of the contract, and then we're stuck with this tenant for the next year, right? So what we do is we let the property management company choose a tenant. So we don't get to choose a tenant. You don't get to choose a tenant. We let the property management company, who has way more experience than you and I of leasing up properties, because they have over 1,500 doors in Cleveland and greater Cleveland area. And we let them, with their data and analytics, choose the best tenant that they think is going to, fulfill their lease and renew their lease, et cetera. And so they do a lot of stuff to vet these tenants, background checks, eviction history. They look at their credit score. If their credit score is low, they look at why that credit score is low, which is more important than the score itself. So we put all of our faith into the property management companies in choosing the tenants. And, you know, you will too, once that tenant, if you end up buying a property and that tenant does move out, right, then you're going to put your faith in them to choose a tenant as well. So that's what we do in terms of the tenants. And so nobody gets to decide. We let the pros choose the best tenant.
Yeah, and Crystal is asking if we will eventually start selling the apartment buildings on the website. So that is, right now, our intention is really to hold on to them. We've been talking about maybe selling one
of them,
12 unit in Memphis. We're not sure, but right now our plan is really, you know, as usual, our focus is passive income. So we're really looking for investors that want to kind of invest in these multifamilies with us. And then, and actually, I think we just sent an email today, a listing for a 12 unit in Cleveland. And we're looking for a couple of investors to join us in that. And the opportunity for these multifamilies is that we're managing everything. We're rehabbing the property. We're investing in that property as well. So we're going to be side by side. And then you have an opportunity then to stay with the company and with that property, and then get the cash flow from that property as well. So that's a great investment, and then you don't have to worry too much about rehabbing the property, finding the tenants, and then managing the property moving forward. So if you haven't received, Crystal, the email about that 12 unit in Cleveland, send us an email and we can forward that to you if that's something that interests you. And then if we decide to sell one of those apartment buildings, which I'm sure will happen eventually, then we'll advertise it as usual to all our investors.
Yeah, it won't be for a while before we end up selling that one, but yeah.
You have to answer the question from Stephen. How many property managers did you interview before you chose the one?
Well, let me ask him a follow-up. How many property managers are there in Cleveland? All of them. So that's my answer. So I talked to every single property management company in Cleveland, and no idea. I called every single one of them and shook hands and either drove around with them for a full day, meaning 3 to 4 hours, or had a coffee with them and kind of just picked their brain about their property management company, how they're set up. A couple of them, I went and checked out their office space and how they were set up that way, right? And then I came back home after doing that for a week and a half, and then I chose the company that we're currently using today, and it was a good pick. We've been using them ever since, and we haven't changed at all, and we've been growing with them, and they've been growing with us. So it's been a great relationship for us, and also that property management company who now gets 10 new clients from us every single month.
Yeah, I agree. I mean, there are a lot of bad property management company, but sometimes I think it's also, they're not necessarily bad. I think it's sometimes a bad fit. You have to have a property manager that they're used to multifamilies, or they're used to these large portfolios, or in certain areas, not these areas, or A and B class, not C class. And I think it's you have to find the right fit for you in terms of the property managers, I think, so that they're going to pay enough attention to you. You're going to be a client that's going to be important enough for them to pay attention to, and then you can work with them. That's the advantage that we have, is that we're working with them all the time. We're bringing them 10 properties a month, and then they can we can tweak the system. We can make sure that the process works properly, that they take care of our investors and all that kind of stuff.
Yeah, they sure do, because we're bringing them 10 clients and 10 houses for their portfolio every single month, right? So they really do take care of our clients. And, you know, if any challenges or issues occur, you know, throughout the life cycle of your property and your ownership with them, then a lot of the times they're reaching out to us for, you know, keeping us posted as to what's going on with you guys and your properties, and maybe where we can step in to help figure stuff out and make it a good situation for everybody.
Yeah. All right. Okay. So yeah, so Stephen, you had a good experience then with the one in Cleveland.
And then, yeah, Cole. So nice. That's good to hear, Stephen. Glad you like them. We like them. They're very systematized, which I bet you can tell. Even when it comes to getting rid of tenants and doing the eviction process, which a lot of new investors do not really like. They would like them to be more hands-on with the tenants, but there is certain rules and regulations that these property management companies, especially once you get to this size, which is like 1,500 doors, that you have to follow, because you do have to abide by the laws of that state or city or county in order to, you know, go through that whole eviction process. So they're following the rules. They have a system that does follow the rules, and make sure that things get, you know, done on time and quickly. Yep, super fun. Yep, I agree. And then Cole asks, is the only place to purchase properties on the website? Yeah, we do have all of our properties on the website. That's the best and only place to find them. Also, if you're not on the email list, we can put you on that as well. So every Thursday we email new properties. Every Tuesday we email information about our property locations. So like our markets and stuff that's happening in our markets as well. So, okay, I'll add you to the email list. No worries.
Yeah,
And
we'll
add
take
you there.
all the email from the registration and then add them to the mailing.
Put them to the list. Okay, cool.
Yeah.
Yeah. And the only place is there. And you can even, we made it even simpler to, you know, now you can go and make an offer, as Eric said earlier, to even make an offer on the website, and that goes directly to us. And it's, a lot of people have bought properties right through the site without any interaction at all. They just look at the financials, review them, and they move forward. So it's been great.
So so we're at the top of the hour now, so I'm conscious of people's time. And so I just want to point out two things. One of them is a rental property analyzer. So this is a free application that we built on, it's on the iOS, on Apple, as well as the Android platform. So feel free to download it. And it helps you do the calculations very quickly. And then you can save the properties and stuff like that, and have different assumptions for calculating your cash flow and your cash on cash return and your cap rate. So that's it's called the Rental Property Analyzer. So if you want to download it, that'd be great. And then finally, if you want to, if you have any additional questions, you want to schedule a meeting with me, I have my Calendly link here. You can email me, and you can also look at my YouTube channel as well as Antoine. I don't have his information here, but anyway, so this is, feel free to connect. We're here to help you. And so thank you very much for participating. Have a great end of the day.